Positioning is light again, and people are getting very bearish again. And last time that happened, we saw what, a 17% rally in the market in midsummer.
That's absolutely right. And I think it's one of those things from a positioning standpoint. If there were something to turn, then you would see maybe a pretty fast rally off the lows. That being said, where the market is pricing right now, it's not pricing in a recession. It's not pricing in any type of earnings contraction as well. And so that's why it's not a function of not being invested in the market. It's picking your places in the market. So if you have equity exposure, leaning into quality, leaning into some of those sectors that are actually resilient in recessionary environments, like healthcare, like consumer staples, and then balancing that out with some quality fixed income, where now you're earning yields that far exceed the dividend yields in U.S. equities. So having that balance is a way that you can benefit from some of those bounces, granted not to the extent that we saw, but still have some skin in the game.
Why do you like healthcare and staples over, I don't know, real estate and utilities?
And so I think healthcare is one of those areas. It's an area that we've liked for quite some time. It's obviously held up quite well, and it's a favorite of many people. And for that reason, I think when you look at if we are nervous about earnings contractions, if we are nervous about that tightening of financial conditions, you need to look to places in the market that have inelastic demand. Healthcare obviously provides that. And when we look at the past 3 recessionary environments, a sector like healthcare has been one of the few sectors that has been able to consistently grow their earnings for that period of time. So that's where we're very specific. We want that inelasticity of demand in terms of where we're picking our spots.
Kristen, thank you for joining me with some of the advice that you are giving to your clients.